While most people have been glued to the Iran war, the market has been quietly telling a much richer story underneath the noise. That is usually how the best opportunities arrive. They do not arrive when the world is calm and generous and eager to hand you clarity. They arrive when fear is occupying everyone's attention so completely that important changes slip through the cracks. That is exactly what I think is happening right now. You can feel the fear in the tape. CNN's Fear and Greed Index, according to the source, has been stuck in extreme fear for the last 4 weeks, one of the longest such stretches in recent memory. That is not a small thing. Fear does not merely change headlines. It changes how people process every new piece of information. It makes them reactive, it makes them smaller, it makes them focus on immediate danger instead of long-term value. Fay-Falasite-Fay-Turn 41 file 0 Fay, and of course the reason for the fear is easy enough to understand. You had headlines about Iran. You had language so extreme that normal people heard it and instinctively wanted to pull their money out of the market and wait for some adult to declare the coast clear. Then one day later, the world got a 2-week ceasefire. Oil fell sharply. Stocks ripped higher. The same people who wanted out suddenly felt foolish for wanting out. That is what fear does. It whips people around, it narrows their field of vision, and that is why I have always preferred a framework over a feeling. If you want to be greedy when others are fearful, then you need some way to measure the fear instead of just swimming in it. That is why I respect indicators like the Fear and Greed Index. It is not magic, it is not prophecy, but it does force you to quantify what the crowd is emotionally broadcasting through momentum, volatility, safe haven demand, options, positioning, and breadth. When that composite sits at the lower end of the range for a sustained period, you should at least ask whether the market is starting to sell you good businesses at prices more generous than reality deserves. Fay file site Fay-Turn 41 file 0 Fay, that is where I begin. Not with the panic, with the mismatch. And once you start looking through that lens, you begin seeing what the crowd missed while it was staring at the war. The first story I want to talk about is Nebius. This one matters because the market has a habit of pretending that giant endorsements do not matter until the price has already doubled, and everybody suddenly becomes a genius in retrospect. According to the source, NVIDIA announced a $2 billion investment in Nebius as part of a larger long-term partnership to deploy more than 5 gigawatts of NVIDIA systems by 2030. Then, almost immediately after, Meta announced a 5-year AI infrastructure deal with Nebius worth up to $27 billion. With the first $12 billion of compute capacity expected by 2027 and the option to buy up to $15 billion more. That capacity is not sold elsewhere first. Those are not cute little letters of intent. Those are giant strategic commitments from 2 of the most important AI companies in the world. Fay file site Fay-Turn 41 file 0 Fay, that matters because I care very deeply about what informed capital is doing with real dollars. People say all the time that they want exposure to AI. Fine. Let's put exposure to AI as meaningless as a phrase. If you do not know where the money actually has to go for AI to scale, Nebius is not being pitched here as some general-purpose software darling. It is being described as a neocloud company focused on AI infrastructure for sovereign AI and highly regulated industries, things like finance, healthcare, and defense. That means it is living in a much harder and more valuable part of the stack than casual investors tend to appreciate. Fay Falasite Fay-Turn 41 file 0 Fay, and then comes the really interesting part. The source says analysts estimate those deals, once fully built out and online, could add somewhere around $4 billion to $6 billion in annual recurring revenue for Nebius, versus a current run rate of roughly $1.25 billion in 2025. Management itself is guiding for $7 billion to $9 billion in AR by the end of 2026, implying a greater than 5-fold expansion year over year. Those are not ordinary growth numbers, those are re-rating numbers if the business actually delivers. Fay file a site, Fay-Turn 41 file 0 Fay. Naturally, the market has not simply handed over full credit for all of that. Why? Because the market does not like handing out certainty before the infrastructure is fully online. The contracts are visibly compounding into the numbers, and the volatility has had a chance to frighten everyone at least twice. Fine, I do not mind that. That is how you get paid. According to the source, discounted cash flow models like Simply Wall Street's estimate fair value above $600 per share, with the claim that the stock looks roughly 80% undervalued and may need to multiply many times over to reach full value once the market begins treating the new infrastructure deals as real rather than aspirational. I am always careful with fair value numbers because models can flatter assumptions, but the broader point is still valid. When Nvidia and Meta are each effectively telling you this business matters to the future architecture of AI, you had better not dismiss the story just because the chart still looks volatile. Fay turn 41 file 0 Fay. That is how markets train people to be late. They wait for the chart to look comfortable by then. The easy part is already over. Now let us move to Microsoft. This is a different kind of opportunity, and I like it for different reasons. The source points out that Microsoft has been trading near its 200-week moving average for the first time in over 13 years. That is not a trivial technical observation. A 200-week moving average is roughly 4 years of average closing price data. It is the kind of line that smooths out the daily shouting and reminds you where the long-term trend actually lives. For great businesses, that line often acts like a floor where patient capital starts showing up. Fay turn 41 file 0 Fay. That is exactly the sort of setup Charlie Munger respected. The source quotes the spirit of something Munger believed strongly, that if you bought high-quality businesses at those kinds of long-term support zones, you could do very well over time, often better than the broader market. I think that instinct is right because it combines two things I care about more than almost anything else: quality and price discipline. Fay turn 41 file 0 Fay. Now look at the numbers. Microsoft is down more than 20% year to date, making it, according to the source, the second worst performer among the Magnificent Seven after Tesla. But unlike Tesla, Microsoft's revenue, gross profits, and earnings per share all grew by around 15% over the past year, and from a much larger base. That is a huge difference. One company is being repriced partly because its economics are wobbling. The other is being repriced while the machine underneath keeps growing. Fay turn 41 file 0 Fay. That is the kind of distinction I always want investors to see more clearly. A stock can fall for reasons that have nothing to do with the long-term value of the enterprise, and when that happens in a company like Microsoft, I pay attention. The source says discounted cash flow models put fair value around $450 per share, while some analysts see targets north of $500, suggesting something like 17 to 25% undervaluation and perhaps 20 to 33% upside from current prices. Fine, again, I never build a whole thesis on one model. But when a world-class business with one of the strongest strategic positions in software and cloud falls all the way back to a long-term support zone while the business itself keeps getting bigger, that is exactly when I want to be asking harder questions, not retreating into fear. Fay turn 41 file 0 Fay. Microsoft is not exciting in the juvenile sense. Good. I prefer great machines to entertaining ones. Now, let us move to Marvell. This story is much more about position inside the AI supply chain, and that position matters more than many investors realize. According to the source, Nvidia invested another $2 billion into Marvell and pulled it directly into the Nvidia ecosystem through NVLink Fusion. That phrase sounds technical, and it is. But the business meaning is very important. NVLink Fusion is described as a plug and play connection system that lets custom chips from other companies snap into systems and speak to NVIDIA GPUs at full speed. In plain English, NVIDIA is not only defending the part of the rack it already dominates, it is trying to remain central even in environments built around other companies' components. Fay turn 41 file 0 Fay. That matters because Marvell is being invited into the inner circle of that architecture. The source says Marvell will build custom AI chips, XPUs, and high-speed networking gear that connect into NVIDIA's environment. While NVIDIA supplies the broader rack infrastructure around them, then they add another important detail. Marvell and NVIDIA are also working together on silicon photonics and optical interconnects. That matters because when the industry starts needing to move more data faster with lower energy cost, the copper-heavy legacy assumptions begin breaking down. Light matters, optical transport matters, photonics matters, Fe Felicite Fe turn 41 file 0 Fe, and then the story gets even stronger. Marvell had just closed its $3.25 billion acquisition of Celestial AI, which the source says makes photonic fabric, technology that uses light instead of copper to move data between chips and memory inside AI data centers. So now you have a company already strong in custom silicon and networking being pulled into NVIDIA's ecosystem while simultaneously strengthening its own optical position. That is not random good news. That is strategic concentration. Fe Felicite Fe turn 41 file 0 Fe. This is what I mean when I say investors should stop thinking of the AI build-out as one company and start thinking of it as a layered industrial system. The winners will not only be the most famous names, the winners will also be the ones sitting at the choke points inside the system where substitution is painful and demand becomes structural. That is why Marvell belongs in the conversation. Now I want to pause on ARM because I think the source handles this one correctly. ARM recently announced its first self-branded chip, the AGI CPU designed for AI inference in data centers. The technical story is interesting enough. A high-core count CPU designed for a world where inference becomes more important, more intensive, and more power. Conscious Meta is the first customer, and the source says others like OpenAI's Cirrus and Cloudflare are lined up too. Fine, that is a real signal. Fe Felicite Fe turn 41 file 0 Fe, but then comes the problem. If ARM starts designing and shipping its own chips, it is no longer only the neutral licensor of architecture. It starts competing more directly with the same companies that license its designs: Qualcomm, Amazon, Microsoft, NVIDIA, others. The source is right to be cautious here. It is one thing to own the standard. It is another thing to begin competing against your customers while the actual product still has a long path from design to meaningful production. Chips take time. Competition reacts. Alliances shift. Fe Felicite Fe turn 41 file 0 Fe. That is why I would treat ARM less as an obvious buy, right now story, and more as an important signal that the AI data center CPU landscape is changing. Sometimes the best investment lesson in a development is not buy the stock immediately. Sometimes it is understand how the industry structure is shifting. That is what I take from ARM here. Now let us move to one of the most consequential pieces of the whole source, Anthropic. On the 6th of April, according to the source, Anthropic announced a new compute deal with Google and Broadcom, giving it access to roughly 3.5 gigawatts of next-generation TPU capacity starting in 2027, on top of the 1 gigawatt of Google TPU capacity already coming online this year. In total, about 4.5 gigawatts. That is a breathtaking amount of compute. The source makes the point vivid by saying that amount of electricity is enough to power over 3 million homes. Whether you use the exact analogy or not, the scale is obvious. This is not niche capacity. This is industrial scale AI power. Fe Felicite Fe turn 41 file 0 Fe, and Broadcom sits right in the middle of it. That matters enormously. Broadcom is not just some peripheral vendor here, according to the source. It is designing the custom TPUs and the networking equipment, connecting the whole thing together under a long-term supply agreement with Google that runs through 2030. That is exactly the kind of picks and shovels position I like. The model companies and hyperscalers may grab the glamour, but the suppliers sitting between them, supplying critical architecture and connectivity at massive scale, are often where very durable value gets created. Fe Felicite Fe turn 41 file 0 Fe, now layer in Anthropic's own growth. The source says Anthropic's revenue run rate is already over $30 billion a year. up from around $9 billion at the end of 2025. That is a staggering acceleration in less than 3 years, according to the source. Anthropic has gone from effectively pre-revenue to a run rate larger than what many SP 500 companies ever reach. That matters because it changes how you should frame the company. This is not just another OpenAI competitor trying to survive. This is becoming core infrastructure in the AI economy. Phaephilosite Phaeturn 41 file 0 Phay, and the source then adds the most dramatic element of all. Anthropic has a still unreleased model called Claude Mythos, described as more powerful than its current frontier models and apparently so dangerous in the wrong hands that the company is not releasing it publicly. Instead, it is using that capability defensively through Project Glasswing with partners including CrowdStrike, Palo Alto Networks, Broadcom, Amazon Web Services, Cisco, Microsoft, NVIDIA, and JP Morgan. The goal is to point the model at infrastructure and code bases to discover vulnerabilities before adversaries exploit them. Phaephilosite Phaeturn 41 file 0 Phay. Now, whether one chooses to emphasize the drama of that announcement or not, the investment implication is still very important. Anthropic is not merely becoming a model company, it is becoming a partner to some of the largest enterprises and infrastructure players in the world. That is a different level of relevance, and it has a second-order implication. Companies like CrowdStrike and Palo Alto Networks may be getting early access to tools their competitors do not yet have. That can matter a lot in the next phase of AI-powered cybersecurity. If the offense gets stronger, the defense has to get smarter faster, and the earliest access to the strongest defensive tools can become a huge advantage. Phaephilosite Phaeturn 41 file 0 Phay. I think the source is absolutely right to call attention to that. Now let us turn to memory, because this is another place where the crowd keeps missing the real lesson. Google DeepMind unveiled a compression technique called TurboQuant, which attacks one of the biggest bottlenecks in running large models, the memory footprint tied to the KV cache. According to the source, it can shrink memory needs around 6-fold without losing model accuracy, and in some benchmarks speed up inference calculations on GPUs by up to 8 times. Markets reacted in the usual shallow way. Memory stocks sold off: Samsung, SK, Hynix, Micron, SanDisk. People assumed that if the memory burden goes down, the memory opportunity goes down too. Phaephilosite Phaeturn 41 file 0 Phay. That is exactly the kind of linear thinking that keeps investors poor. This is where Jevons paradox matters. The source uses DeepSeek as the analogy. When compute got cheaper, did demand for compute shrink? It exploded because lower cost did not kill the market. It widened the market. More people could afford more use. The same logic can apply here. If memory becomes more efficient, that does not automatically mean less demand in the long run. It can mean much more AI usage, much wider deployment, much larger context windows, and many more production workloads, all of which can still drive total memory demand much higher. Phaephilosite Phaeturn 41 file 0 Phay. That is why I like the Micron section so much. According to the source, Micron may have just printed one of the best quarters in its history, revenue up around 75% quarter over quarter and 196% year over year, earnings up over 700%. Guidance for the next quarter around $33.5 billion in revenue, another 40% jump in just 90 days. Those are not the numbers of a dying commodity business. Those are the numbers of a strategic bottleneck being repriced by demand. Phaephilosite Phaeturn 41 file 0 Phay. And that brings us to one of the most important phrases in the whole source. Memory is no longer a commodity. That is exactly right. If memory were still just a generic interchangeable line item, it would not be one of the hardest things to scale in the AI stack and one of the places where profit pressure is rising. But the source says Roundhill even launched the first dedicated memory ETF, DRAM, explicitly pitching memory as one of the most constrained layers in the stack. That tells you something. Entire products are now being created around the thesis that memory, once dismissed as dull, is becoming strategically central to the AI age. Faithful site Fay turn 41 files 0 Fay. I think investors underestimate how often that happens in great cycles. The boring component that nobody respected becomes the scarce layer everyone suddenly has to own. That is memory right now. Now let us end where the source ends. SpaceX, this is the giant gravity well sitting underneath a lot of the surrounding stories. According to the source, SpaceX is preparing for what could become the largest IPO in market history, potentially this summer, with talk of a valuation in the $1.5 trillion to $2 trillion range. Elon naturally pushed back and called the number nonsense. Fine, I do not need the exact valuation to understand the importance. If SpaceX comes public, you are not just getting a rocket company. You are getting a structure that now includes reusable rockets, Starlink, Grok, related AI through Zakai, and the X platform folded in through prior combinations. It is not one story. It is a stack of future. Facing infrastructures under one umbrella, Fay file site, Fay turn 41, file 0 Fay, and then comes the most ambitious part of all. The orbital data center thesis, the source says this is not science fiction, but part of the strategic roadmap filed with the FCC compute in space, powered by solar, with results beamed back to Earth through Starlink, bypassing the energy and real estate constraints here on the ground. That is an astonishing vision. Whether it arrives exactly on schedule or not is less important than recognizing what it implies. SpaceX is not merely trying to own transport, it is trying to own the conditions under which the next great compute era might physically exist. Faithful site Fay turn 41 file 0 Fay, and then there is Terafab. On the 21st of March, according to the source, Musk announced a $20 billion to $25 billion AI chip manufacturing complex in Austin designed to produce custom silicon for Tesla, SpaceX, and future orbital data centers, with Intel formally signing on as the manufacturing partner. The goal is 1 terawatt of compute capacity per year. That is such a huge target that the source even jokes Intel might be perfect if it simply makes highly inefficient chips. Fine. But the underlying point is still very serious. Intel is being pulled into a major strategic compute build-out. And in markets, one of the most valuable things you can identify is the difference between a dead name and a legacy name that still has a path back into relevance through the right industrial relationship. Fay file site, Fay turn 41, file 0 Fay. That is why I did not want this source to be reduced to simple headlines. This is not really a video about Iran, it is a video about what fear hides. And what fear hid this time was a stack of very important developments. Nebius being validated by NVIDIA and Meta at industrial scale, Microsoft touching a rare long-term buying zone while the business keeps growing, Marvell getting pulled deeper into NVIDIA's inner architecture while optical interconnects matter more. Anthropic becoming a more central AI infrastructure and security player with Broadcom sitting right in the middle, memory getting repriced as a constrained strategic layer rather than a simple commodity, and SpaceX gathering so many future-facing systems under one possible public listing that the whole market may need to rethink how it values the ecosystem around it. That is a lot, and it all happened while the crowd was staring somewhere else. That is why I never want investors to confuse urgent headlines with the only things that matter. The market pays people who can see what others were too distracted to price. That is the whole game, not being louder than everyone else, seeing further than everyone else. And if you can do that while the crowd is trapped in extreme fear, you give yourself a real chance to own the next winners before the world starts calling them obvious.